Hey, it's Tony Robbins again. Welcome back to our e-course here on geometric growth. Listen, geometric growth in your business is worthless if it's not geometric growth in your cash and your profitability of your available cash. I say that because the subject that most people in business are most enthralled to talk about is accounting, right? We all just go, yeah, man, let's get together and brainstorm ways to look through our numbers more effectively. For most of us as entrepreneurs of any size and scope, the majority of people say, I don't want to count those numbers. Let those bean counters do it. Let me just go add value, change people's lives. Let me go market my product, sell it. Let me go deliver this value. Let's create new things. But the accounting side, are you kidding me? So why would I dare put in the middle of an e-course where I'm trying to add value to you and have you be inspired enough that maybe we can become partners together, or I could have you as a client and serve you ongoing? Why would I put accounting in that and mess up the momentum? Marketing is so much more sexy, right? I mean, come on. Because my dear friend, and I'm talking to you as a brother or sister, if you're a person that founded an organization, if you have the guts to go and take the risk, you'll start something your own, whether it's big, small, it's just beginning, or it's $1 billion organization, you and I are brothers and sisters on the path. It takes a unique kind of person to take those kinds of risks. And unfortunately, the kind of person that takes kinds of risk rarely, unless they really have spent time to be educated in this area, knows how to direct and manage their financial side of their business. We know fundamental things. We know the things how to grow it. And we know enough to be able to get momentum and build a 30, 40, 50, 100, 150, $200 million company, depending upon your industry. But almost every business has the Peter principle. That is, people rise to their levels of incompetency. You can get by with a lot when you're a small company growing like crazy, but when you bump into some bad weather, when you bump into an economy where things like 2008 just tighten up, or when you come into some technology change that jolts your offering, where all of a sudden you've got a new competitor you weren't ready for, when things like that happen, if you don't know how to manage those finances, you can grow, gone, as we've always said in business. It's not enough to be successful. You gotta be successful financially. And so this is a subject that, believe it or not, can become fun and sexy and playful for you and enjoyable. I don't know if sexy, that might be stretching a little too far, but it's really cool when you can take a business. This is what we do with our businesses. We take companies in and show them how to increase their net profitability in cash in 90 days or less. I mean, when you do that and you make a change of 30, 40, or 50% or more, you get people saying, man, they start chanting, I love charts, charts loves me. I love accounting, accounting loves me. You watch a shift in people's step around this area. The biggest mistakes I've made in my entire business career personally, and the dozens of companies that I've worked with and built over the years myself, a dozen or so I've built, all the problems I ever got into are what I mentioned in a previous conversation we had. I think I shared with you, I've had times where I was driving the business and I check in. I get all the financial sheets. In those days, it was a binder full of stuff. Today, fortunately, it's just a file on an email. But I'd be like, you know what? Let me just shoot down what most of us do as business owners. Shoot down, what's the bottom line, right? Isn't that all we want to know? What's the bottom line? And it looked good, I was like ready to rock and roll. If it didn't look good, oh my God, I had to do something. But profit is a theory. It's important you understand that. Profit is an accounting theory. I can remember years where I had this big profit, but there was no cash. Has it ever happened to you in business? If not, we're going to prevent it so it doesn't happen. If you have had that experience, you know what the kind of gut check that is. You're like, what do you mean? Well, we've all this profit. Where's the cash? They're not the same thing. Accounting's a theory. So today we'd like to introduce you to Keith Cunningham. Keith is a dear friend of mine. He's got a Harvard MBA. He's got a degree in accounting. And when people come to Business Mastery and Business Mastery 2, our advanced course, we do 4 hours in the first course, and we do 2 days with Keith in the long course. And people who would never dream of this come out of this excited about numbers and totally empowered. It's like, imagine you're trying to go fly an airplane, and I always tell people this because I'm a pilot, and you don't know how to read the dials. You can get by with that stuff when the weather's sunny. They call it VFR flying, visual flying rules. You can just take off and look around, see where you're going to land. But man, when a big storm comes in, that's how people die. When you get the clouds around you, and that happens with economies, or competition or technology change, all of a sudden, man, you think you're doing one thing and you get disoriented because you've lost the field of vision of the visual. And the only way you can fly that airplane is you got to read those dials precisely, and you got to trust the dials. Even though your body says, I'm this way, no, the dials say this way, this is where I'm going. The dials of your business are the accounting. And we want to convert accounting into, instead of a bunch of numbers and charts, into intelligence. into something you can now use to make better decisions, to run your business and to become more successful, not only today, but for the rest of your business life. So it's almost like teaching people a new language. Lawyers have a lot of power. Doctors have a lot of power because they have their own words. Iatrogenic means physician-induced disease, right? But here, iatrogenic, that's interesting. What you need to do in your business is know that accounting has some language, and if you understand it better, and by the way, even if you're already great at accounting, you're like, Tony, this is interesting, but why did I watch this session? I think you should watch this session because you may know some of this stuff, but you're not practicing it. Knowing is not enough. You and I both know it. Mastery is when you do it all the time, not you have the information available and you understand it. That's level 1 of mastery. 2 is you have the information and you have enough emotion, you do it most of the time. Deep level, 3-dimensional mastery is you just do it every time because it's who you are. Plus, if you want to make money, that's one thing. It's not what you make, it's what you keep. And this is where you can decide what you get to keep if you manage it right. So if you know accounting and you're really strong at it, maybe you watch and say, is this stuff I'm really doing even though I know it? Or watch and see how this man might share a message in this little short time we're going to give him, at least this part of it, because maybe it can help you get this across to your own people. Because one thing I've learned in my businesses, one person trying to solve 12 problems is not as powerful as 12 people trying to solve one. And one problem we all have is costs. Making sure those babies are being ground down while we still add value to the customer. And if you've got your people understanding more about what's really going on with your numbers, now you can enroll those people and you can get results so much faster with everybody working on it instead of just you. That's one of the secrets to taking a business to another level and get geometric growth, not only in the revenues, but in the net cash positions and in the net profits positions. So without further ado, let me introduce my dear friend, Business Mastery Facilitator, multi-billion-dollar deal maker. He's done so many over the years, just incredible entrepreneur, funny as hell, dear friend, Keith Cunningham. Enjoy.
Without a scoreboard, you don't know the score, and if you don't know the score, you can't tell the winners from the losers. Measuring is critical. Here comes the most important thing I'm going to say. Have I already said that? Well, forget about those others. I wasn't to this part yet. This is the most important thing I'm going to say. Anybody who doesn't want to measure doesn't want to be held accountable. Write that down. That's good. Well, it is. I know when I'm good. That one's good. Anybody who doesn't want to measure doesn't want to be held accountable. And most people, in reality, don't like to measure. And the reason is because they don't want to be held accountable. I don't know how to improve anything unless I'm willing to measure. I have to be able to measure if I want to improve. The best in the world at what they do are measuring freaks of nature. They're freaks. This guy, Michael Phelps, who won like 87,000 gold medals, this swimmer, have you heard of this guy? This guy is a measuring freak of nature. They're looking when he swims whether or not his thumb is like this or is it like this. They're measuring what does Michael have for breakfast before he swims his fastest time. What is he doing with his legs? Are his toes together or are his toes a little bit apart? They're measuring everything all the time. And the reason they're doing that is because he wants to win gold medals. That's why they're measuring. In order to get better, you have to be willing to measure. And what we want as business owners is not massive expertise in accounting. What we want to do is be able to plug the profit drains and maximize cash and spot danger signals and drive our results. In other words, we want optics. We want to be able to see, what am I missing? I got all these numbers. What do they mean and what am I missing? And that's what I'm here to do. I'm here to help you both today and tomorrow get some optics so that you can run the business into your business. In order for me to do that, I'm going to start with this. I'm going to teach you 6 months worth of accounting in 20 minutes. I'm not going to use the D word or the C word. That's really good. I need for you, when I ask you a question, to call out the answer so that Tony knows you're getting it. Stay with me on this. The report card that is probably the most important report card in the accounting world is a report card that has this. This report card is going to keep track of the things and stuff in our businesses. Businesses have things and stuff. And the things and stuff in a business are things and stuff like cash, accounts receivable, which is money that's owed to us by our customers, inventory or stock, inventory, and property, plant, and equipment, PPE. Property, plant, and equipment is things and stuff like a vehicle or machinery or a building. All businesses have things and stuff. And we either owe money on our things and stuff, or we own our things and stuff. A business has some things and stuff. And a business either owes or it owns its things and stuff. If it owes on its things and stuff, that would be called a payable, an account payable, which is money we owe to our vendors, or taxes payable, or notes payable, which is money that we owe to the bank. Those are all things that we owe. And a business owns the investment that was made by the shareholders, and it owns its earnings. A business owns its profits. A business owns its profits. This particular piece of paper, the accountants have very cleverly called a balance sheet. A balance sheet. And the reason the accountants call this a balance sheet is because the left-hand side, things and stuff, always equals what you owe plus what you own. It's a balance sheet because it balances. It's a balance sheet because things and stuff equals what you owe plus what you own. If I showed you a balance sheet, that could be a problem here in a minute. If I showed you a balance sheet that looked like this, and I said that things and stuff are 100 and what we owe is 80, how much do we own? You're all a bunch of little budding accountants. That was really, really good. Because you knew that this balance sheet, 100 is going to equal 80 plus 20. It balances. That's what a balance sheet does. A balance sheet, which is this piece of paper right here, here comes the problem. This piece of paper right here is a balance sheet. We've got some things and stuff. We got something that we owe, and we got something that we own. Now, accountants don't use things and stuff. I kind of wish they did, because it makes more sense to me. What accountants say are things, they say your things and stuff are really an asset, and what you owe is a liability, and what you own is equity. So another way to say this is assets equals liabilities plus equity. Things and stuff equals what you owe plus what you own. This particular report card that accountants prepare is different than the other two. There's only three. there's only 3 report cards that are primary dials for accountants. This is kind of the main one. Most people don't know that. Most people think the income statement is the main one. This is actually a main dial. This particular dial is different from the other 2 because this dial is a snapshot. It's a snapshot. It's a moment in time. This is the way it looks right now. In fact, if you look at your balance sheet that you may have gotten from your accountant, it will always say as of. As of. This is a snapshot of this balance sheet as of December 31st, 2012. This is a snapshot of the business as of March 31st, 2011. It's a moment in time, and this is different from the other 2 primary report cards that businesses get. This is an accounting report card. It has 3 parts. On the left-hand side is things and stuff. On the right-hand side is what we owe and what we own. This report card is called a balance sheet, and it is a snapshot. It is a moment in time. There's a second report card that accountants prepare. The second report card looks like this. The second report card I'm going to draw like this. This report card is going to keep track of sales or revenue or turnover, all the same thing. Sales, revenue, turnover, all the same thing. Minus the expenses or the costs to produce those sales. Sales minus expenses equal the bottom line. The bottom line is profits, net income, or earnings. All of those are the exact same thing. Profits, net income, earnings, they are all the bottom line. The bottom line. This particular report card that accountants prepare is not a snapshot. It is a movie. This report card is a movie, and it's called an income statement. So it might be called an income statement. It might be called a P&L. It might be called a profit and loss. It might be called a statement of operations. A statement of operations. That's one of the problems, is that some of these terms wind up with like 8 or 10 different words, and they all mean the same thing. So a profit and loss, an income statement, a statement of operations, a P&L, all the same thing. This particular piece of paper is a movie, and most importantly, when you get your financials, chances are this is the one piece of paper that you look at. Hello? Is that true? And in fact, this number right here is that's the first thing you look at, is the bottom line. And if it's a good number, you'll go have a drink. And if it's a bad number, you go have 2 drinks. Now, I'm going to say something that's really, really important. It's not the most important, but it's really, really important. This particular piece of paper is a theory. There is no factual information on this piece of paper. It's a theory. It's not a fact. And so all of this time, when you get your report card from your accountant and you look at the profits or the bottom line or the net income, and then you go have a drink or 2, when you do that, you're drinking about a theory. There is no factual information on this piece of paper. It's a very important theory, but there's no factual information. Here's all I can tell you. Hear me now, believe me later. So I'm going to prove this to you tomorrow morning. Tomorrow morning, I'm going to prove to you that this particular piece of paper called an income statement has no factual information. It is designed to be a theory. The other piece of paper, the first one we talked about, called a balance sheet, it's designed to tell you things and stuff and whether you owe or own your things and stuff. This one is not designed to do that. This piece of paper is designed to say how much were your sales or your revenue or your turnover, how much were the costs, and how much was left over in theory. This is also a movie because this particular piece of paper is for the month of January, not a moment in time. This is for 2012. This is for Q1 2011. This is a movie. It is what happened to sales for the month, the quarter, the year. What happened to expenses for the month, the quarter, the year? What happened to the bottom line for the month, the quarter, and the year? But a balance sheet is a snapshot. So far, we've talked about 2 report cards. The third report card looks like this. These are accounting report cards. These are not school boards. These are accounting report cards. This particular report card is designed to keep track of cash. And it's called a statement of cash flow. And the reason there's 3 boxes is because cash can be generated or used in 3 different ways. Cash can be generated as a result of operations. That's called O-cash. Operations, operating cash, that's O-cash. There's I-cash, which is investing, and then there is F-cash, which is financing. Financing cash. O-I-F. O-I-F. Let me give you an example of O-cash. If I collect my accounts receivable, that's operating cash. If I meet payroll, I'm going to use operating cash. Let me give you an example of I-cash. If I buy a new truck, I've used I-cash. If I sell a used piece of machinery, I've generated I-cash. Let me give you an example of F-cash, financing cash. Financing cash could be generated if I borrow money from the bank. If I repay the bank, I've used F-cash, financing cash. If I raise money from my shareholders, I've generated financing cash. There's 3 different kinds of cash, and one of these is more important than anything else in your business. One of these is more important than anything else in your business. One of these is more important than anything else in your business. It is the whole reason that you are in business. This particular piece of paper is not a theory. This piece of paper is a fact. Cash is a fact. Profits are a theory. Cash is a fact. Profits are a theory. Cash is a fact. Why would I say that? Because you can't spend your profits. And yet most of us get our income statement and we worship this number that's the bottom line. We get our income statement, and all of a sudden we look at this number right here, and we get all excited. Check this out. Check this out. Suppose I have a business whose sales are 10, whose expenses are 6, and whose profits are 4. Suppose I have another business whose sales are 1,000, whose expenses are 996, whose profits are 4. Check this out. They got the exact same profit. It's the exact same number. Why would I go have a drink over either one of these numbers? This number right here is simply the math of what happened to sales or turnover minus expenses. And are these two entirely different businesses? Hello? Yes. These are two entirely different businesses, and yet one of these guys may be drinking and the other one is not, and yet they both have exactly the same bottom line. And I look at that and go, why would either one of them have a drink? I don't know if this is good or bad because I've got no trends and relationships. I got no optics. So how would I know? If I said, is this high or low? I got no idea compared to what. I got to have something to compare it to if what I'm going to do is have optics.